Hi there. Thanks for tuning in. Today, we're going to be doing an analysis and valuation of Victoria's Secret & Co. Now, this company basically doesn't need an introduction, but we just give you an overview. They sell women's lingerie, women's underwear. They also sell clothes through their Pink line, for example, and they sell a couple other beauty products. I think their perfumes are especially very well known and selling. So that's what they do. And I want to go a little bit through the recent history of Victoria's Secret. So something that happened was that actually they were part of L Brands, which also owned Bath and Body Works, and they spun off Victoria's Secret to become its own brand. Now it's trading under VSCO, and they are just completely independent now from the parent company. Now, following the brand positioning, Victoria's Secret increased sales significantly in 21, also maybe a little bit in 22. So that's what started happening. Now, what then happened was that in October 23, they basically started planning on reverting the rebranding and going back to their strategy from before because those sales increases just turned into plunging sales afterwards, and the sales are still plunging right now. So that's very interesting. They also made an acquisition as recently as November 22. They bought a lingerie brand, Adore Me. So something to note about their recent history. It is changes and also some struggles in recent times. Now, let's look at the recent quarterly earnings divided by that very nice lady to the side. So these quarterly earnings are not a great picture. Now, everything is decreasing pretty much. If you look at that 3% decrease in net sales, 3% decrease in gross profit, operating income minus 28%. I mean, that's a ton of money that you just don't have to play with. And when your SG&A goes up, but your net sales are going down, that's going to be pain further down the line. And then net income is down by 59%. Sure, some of it is attributable to higher taxes, but at the same time, in reality, you are doing a lot more wrong with that. So that's just something where you can feel the pain. This has been happening for multiple quarters now, and as we'll see later, it's forecasted to keep going. So here's the consolidated balance sheets. I want to show you what's more in the background of the company, and that is that their current assets are less right now than their current liabilities. I mean, it's kind of crazy. And something important to note is that the inventories are a huge part of the current assets. They have, let's say, around $1 billion in inventories. Here's the problem with that. I have a ton of clothes in a warehouse. Well, maybe a lot of those clothes are stuff from last season or stuff that I wasn't able to sell because not enough people wanted it or too many people bought it very quickly, then it wasn't really a fashion item anymore. People want new things. So is that really worth $1 billion if that was the MSRP I had? Well, not really. If I have to sell it, I may have to sell it at a discount. I may have to sell it in an outlet. I may have to sell it wholesale. So instead of a billion, I'm probably going to get 700 million or 500 million even. So these numbers are deceiving because they're always worth a little less and they're kind of a liability rather than an asset. I mean, they're still obviously an asset because they'll give you cash back, but still, the amount there is something that you can be skeptical towards. Another thing to note is that they do have goodwill, although less than you'd expect for a company this size. But basically, they recover their current liabilities without either rebalancing debt or raising money, and we can raise money by issuing shares, for example. That's something that they have in their options. Do you want that? Do you want, as a shareholder, to be diluted because they are raising shares? I mean, that's not really ideal when you're an investor in this company. So it's just something to note. And also, in general, their long-term assets rarely cover everything. When you discount liabilities and you discount goodwill here, which is not really an asset, their long-term assets just don't really or barely cover for total liabilities. So that's something to note. It's just they're in a tough position right now, and you have to adjust accordingly. Now, their 2024 outlook shows a little bit more of this. So, for the full year, they're going to have a decrease in low single digits of net sales compared to 2023. Even in the second quarter, they decrease in low single digits. Same across the board, honestly. Their capital expenditures will be around 230 million, and their free cash flow they're giving it to us around 175 million to 200 million. So it'll still be positive. They'll still have some cash money with which to do buybacks if they choose, which with which to pay down debt or extra debt at least. So they'll have something to be flexible with, but it's less than previous years, for example. This is still lower than the 2022 levels. So it's still something to be concerned about. Now, I want to make a model. I want to forecast the future here. And here I'm looking at the analyst estimates in Yahoo Finance for revenue. And you see that it's a plus or minus of about $5 million from this 5.99 billion level. And for next year, it's a little more wider of a spread, but not that much. I'm just going to go with a low estimate. I'm going to say they're going to make $5.93 billion for 2025 and 2026. And I'm going to say that about 3% of that turns to free cash flow, which is in line with what they're doing nowadays. So I'm going to plug this into a discounted cash flow model. My only other assumption is that from 2026 onwards to perpetuity, they're going to grow about 3%. This is because, I mean, right now they've been seeing some adversity because of US inflation, because China's not growing like they wanted it to. So they're in a little bit of trouble. Let's just say inflation slows down, China starts growing again. Okay, 3% in perpetuity sounds about right. Okay, so with that said, I'm gonna grab all that free cash flow, I'm gonna add it up, and with a required rate of return of 11%, which is 1% more per year than the market, which will add up to be a ton in the long term. Now, if I divide that by the total number of shares out, I get a fair value of equity of $27.63. But if we subtract the net debt, which is a ton, it's $2.5 billion, then we actually get a negative value, and that's a channel first. I mean, I don't really tend to look at companies with so much debt, but I think this is an important case study. It goes from $27.63 to negative $4.92. Stock can't go negative, it goes to zero. This is just to illustrate that the value of the future cash flows that they can possibly make is just not enough compared to all the debt, to this mountain of debt and liabilities that is coming ahead of them that they will have to deal with, and they might have to restructure the company to deal with. I'm looking at Victoria's Secret Co. since the spinoff. I mean, it's performed horribly. Minus 56%. You're not happy if you're a shareholder of it. The P/E ratio says it's 15, which looks good if you just look at that stuff, but that doesn't tell the story. And the market cap is 1.46 billion, which is lower than the debt. So their debt is larger than their market cap. I repeat, their debt is larger than their market cap. It's great. Retail is just such a complicated business with so much competition and so much overhead. I mean, running a store is not cheap. Having those supply chain things, it's going to affect so much. So it's complicated. They're already in a complicated business and they're in a complicated position, which makes it less appealing for me personally. You can also just see a lack of focus in their brand. I mean, they had all these rebrandings and stuff. So in order to reduce the debt load, significant cost cutting must happen somewhere. Does that mean they'll close stores? They'll lay off people? Who knows? Will they lay off? I know they restructured the executive positions as well, but is that enough? I don't know. And acquisitions will need to stop because more often than not, those are acquired with debt because they don't have any cash. And then consistency in branding just needs to be achieved. So overall, the lesson here is just that consistency is key. You need a consistent branding, you need a consistent mission, you need consistent cash flow, and you need consistent growth, or at least just consistent revenues and sales. And Victoria's Secret just doesn't have that right now. Maybe if they have that one day, we'll take a look at it and reevaluate. But as of right now, I just cannot recommend this company. Now, thank you so much for watching. I hope this was very informative. If there's any other company that you want me to look at, just comment down below and I'll take a look at it. Thank you so much. Don't forget to subscribe and have a great rest of your day.